Y Combinator Conversation Starters Key Talking Points for Brandy Bianchini. Introduction. Hello, my name is Brandy Bianchini. I'm applying to Y Combinator because I've built a complete infrastructure system that solves problems no one else is solving. I'm not asking for help building something. I'm asking for partnership to scale something that's already proven and already needed. The problem. I've spent 40 years learning how systems fail. I've watched brilliant people fail due to lack of infrastructure. I've watched talented service providers sacrifice their expertise because projects weren't properly funded. I've watched entrepreneurs leave their jobs without support. I've watched government agencies mismanage benefits and budgets. I've watched the entertainment industry exploit artists. The problem isn't lack of good intentions, the problem is lack of infrastructure. The solution. I've built a complete ecosystem that solves these problems. It includes legal infrastructure serving both for-profit and nonprofit. It includes operational methodology tested across multiple industries. It includes a technology platform that coordinates impact work. It includes a membership system, personal transformation programs, an entertainment network, a global artist alliance, financing mechanisms, and comprehensive benefit systems. Everything exists in the ecosystem. The proof. I've filled 2 complete grid systems with 32 cells of internal projects. I have 50 plus government RFPs waiting for response. I have a peer network ready to onboard. The system is proven and ready to scale. The ask? I need capital to hire field agents and administrative staff. I need capital for office space in key cities. I need capital for digital media and storytelling. I need partnership to activate what's already built. I need co-founders with finance and operations expertise. I need Y Combinator's network to connect with institutions and partners globally. The opportunity. The total addressable market is over $100 billion annually. I have 50 plus government RFPs representing millions in potential revenue. I have a clear path to $100 million in revenue within 5 years. I have multiple revenue streams. I have minimal competition because most organizations operate in silos. The founder. I have 40 years of professional experience across forensics, healthcare, entertainment, nonprofit, and government. I'm not a first-time founder with an idea. I'm a proven operator with a complete system. I've invested $1.5 million of my own resources, protecting others from exploitation and systemic failure. This is my life's work. The vision. This is what the world needs today: a better way of being, a better way of doing. Infrastructure that supports individuals, businesses, government, nonprofits, and foundations working together towards sustained impact. We're the ones doing it, and we want you to work with us. Key differentiators. 1. We understand the L3C advantage. Most organizations don't know this legal structure exists or how to use it. We leverage it to serve multiple stakeholder types simultaneously. 2. We think systemically. We don't optimize individual organizations, we optimize the entire ecosystem. 3. We have proprietary methodology. Rapid phase planning is proven across multiple industries and can be taught and scaled. 4. We understand capital mechanisms. We can activate program-related investment, donor-advised funds, and community foundation regulations that most organizations don't know exist. 5. We have founder expertise. I'm not a consultant. I've lived in forensics, healthcare, entertainment, nonprofit, and government. I have credibility and insight that external consultants can't match. 6. We have proof of concept. 2 complete grid systems filled with 32 cells of internal projects. 7. We have market demand. 50+ government RFPs waiting for response. 8. We have a peer network ready to onboard. Academy Award-winning cinematographers, entertainment producers, and other experts. Closing. I've spent 10 years building this system. The infrastructure is complete, the methodology is proven, the technology is designed, the programs are structured, the vendor network is in place, the market is ready. I just need capital to hire the team and activate what's already built. Y Combinator's partnership would accelerate this process and connect us with the institutions and partners we need to scale globally. This is the opportunity to be part of something that changes how business, government, nonprofits, and individuals operate. We want you to work with us. Universal Changemakers System Components. A conversation. Female. Welcome. Today we're exploring the complete system that Brandy Bianchini has built. Let's start with the foundation. What is an L3C? Male, an L3C is a low-profit, limited liability company. It's a legal structure that allows an organization to serve multiple stakeholder types simultaneously, both for-profit and nonprofit, while maintaining mission alignment and fiduciary responsibility. Most organizations don't understand or leverage this structure, but it's incredibly powerful. Female. And how does Brandy use it? Male. She uses it to serve businesses, nonprofits, government agencies, foundations, and individuals all through one integrated system. The L3C is the legal foundation that makes everything else possible. What about the operational side? How does she actually deliver services? Through rapid phase planning. It's a proprietary methodology that guides systematic problem identification, solution design, implementation, and scaling. It's been tested and refined across forensics, behavioral health, entertainment, nonprofit, and government sectors over 40 years. Female. So it's not theory, it's proven in practice. Exactly. Brandy has lived experience in all these sectors. She's not a consultant reading about problems, she's a systems architect who's experienced them firsthand. Thought about the technology platform. Male. That's the GRID. Global Responsible Integrated Development Tool. It's designed with a minimum of 16 cells per state, with uncapped squares for projects, events, activities, brands, and businesses. Brandy has already filled 2 complete grids with internal projects, proving the model works. How do people access all of this? Through Black Plum. It's a membership gateway where individuals and organizations can join online or by phone. They get an appointment within 12 hours, they complete an intake evaluation, and then they're matched to the right programs and services. Female. What happens after they're matched? Bella Dynamic takes over. That's the personal transformation program. It includes authentic living and authentic healing services. It supports individuals with personal needs, life-altering changes, family support, retirement planning, and multiple income streams. And if they need financing, Male Benefits handles that. It's an in-house financing mechanism that removes capital barriers. People can access services without upfront capital constraints. Even what about for the entertainment industry specifically? That's where the beautiful Webbed Entertainment Network comes in. It's a 4-channel YouTube multi-channel network that manages production logistics, location scouting, incentive and credit tracking, and crew management. Brandy understands that most production companies leave money on the table through missed incentives and credits. She keeps it in-house. And for artists? BAL, the Global Artist Alliance. It's a guild that supports life-changing needs for artists, creators, producers, directors, cinematographers, and writers. It provides direct impact investment in employment, opportunity management, and matters management. Artists choose the areas they're most passionate about and the causes they want to support. So this isn't just a service company. No, it's a complete ecosystem. Legal infrastructure, operational methodology, technology platform, membership system, personal transformation, entertainment network, artist alliance, financing mechanism, and comprehensive benefits and assurance systems. Everything exists in the ecosystem. Female. What makes this different from what competitors are doing? Most competitors operate in silos. They optimize their own sector. Brandy optimizes the entire ecosystem. She thinks about how individuals, businesses, government, nonprofits, and foundations interact. She's built a system where all stakeholders benefit simultaneously. Female, and she's proven it works. She's filled 2 complete grid systems with 32 cells of internal projects. She has 50+ government RFPs waiting for response. She has a peer network ready to onboard. The system is proven and ready to scale. So what does she need now? Male, capital to hire field agents and administrative staff, capital for office space in key cities, capital for digital media and storytelling, and partnership to activate what's already built. She's not asking for help building something. She's asking for partnership to scale something that's already proven and already needed. Female. This is what the world needs today. Male. And she's the one doing it. Brandy Bianchini's complete story from forensics to global impact infrastructure. My name is Brandy Bianchini. I am a systems architect and proven operator with 40 years of professional experience across multiple industries. My journey has been defined by learning, problem solving, and a deep commitment to protecting others from exploitation and systemic failure. I started my career in forensic science in the 1980s. For 9.5 years, I did fieldwork in body recovery, search and rescue, and crime scene investigation. I learned how to investigate complex problems, gather evidence, and make decisions with incomplete information. But more importantly, I learned how systems fail to protect vulnerable people. In 2003, I was diagnosed with rare genetic bone tumors. This diagnosis changed everything. For the past 22 years, I've been managing rare genetic conditions while navigating broken healthcare systems. I experienced medical negligence. I learned how insurance doesn't cover what you actually need. I learned how fragmented care leads to worse outcomes, and I learned how to help others navigate the same broken systems I was experiencing. In 2004, I founded a Moonlit Room production. I grew it to executive producing major projects. I learned how capital, creativity, and teams intersect. I learned how entertainment can drive social change. And I learned how the entertainment industry exploits artists and leaves money on the table through missed incentives and credits. Throughout the 2000s and 2010s, I worked in government procurement and nonprofit operations. I witnessed firsthand how fragmented systems waste resources. I watched good intentions fail without infrastructure. I saw money get lost in bureaucracy. I learned how government agencies mismanage benefits and budgets. And I learned that the problem wasn't lack of good people or good intentions. The problem was lack of infrastructure. By 2015, I understood what needed to be built. I founded Universal Changemakers Series L3C on December 11, 2015. I spent the next 10 years building a complete infrastructure system designed to solve the problems I had witnessed across all these industries. In 2019, I established operations in the United Kingdom and European Union to ensure that post-Brexit commerce and business operations wouldn't be interrupted. In July of 2025, I launched Eternal Autumn Trust as a private operating foundation to support and fund the work. And now, in 2026, I'm applying to Y Combinator because I've built something complete, proven, and ready to scale globally. What I've built is a complete ecosystem. It includes legal infrastructure serving both for-profit and nonprofit simultaneously. It includes operational methodology tested across forensics, healthcare, entertainment, nonprofit, and government sectors. It includes a technology platform that coordinates impact work across industries and jurisdictions. It includes a membership system and concierge approach to service delivery. It includes personal transformation programs. It includes an entertainment network, It includes a global artist alliance, it includes financing mechanisms, it includes comprehensive benefits and assurance systems. I have filled 2 complete grid systems, which means 32 cells of internal projects, proving the model works. I have 50 plus government RFPs waiting for response, proving the market wants what I offer. I have a peer network ready to onboard, including Academy Award winning cinematographers and entertainment producers. I have everything built. I just need capital to hire the team and activate it. Why am I doing this? Because I lost $1.5 million protecting people from industry exploitation and systemic failure. Because I watched brilliant people fail due to lack of infrastructure. Because I watched talented service providers sacrifice their expertise because projects weren't properly funded. Because I watched entrepreneurs leave their jobs without infrastructure to succeed. Because I watched government agencies mismanage benefits and budgets. Because I watched the entertainment industry exploit artists. My father pushed me to rip the Band-Aid off and let people have what they need to fix these broken systems. And that's what I'm doing. This is what the world needs today, and we're the ones doing it. We want you to work with us.
हेलो कोच, प्रोक्योरमेंट में गुड्स या सर्विसेज प्रोक्योर करने के लिए जनरली दो अप्रोचेस अप्लाई की जाती हैं, जिन्हें एस टू पी यानी सोर्स टू पे और पी टू पी यानी प्रोक्योर टू पे कहा जाता है। ये दोनों अप्रोचेस तो बाज़ाहिर सिमिलर लगती हैं, लेकिन इनमें कुछ डिफरेंसेस हैं।
In this video, I'm going to explain to you what debits and credits aren't, define them, and show you why this is going to help you out. Hey guys, my name's James and welcome back to another episode of Accounting Stuff. This video is the second in a series that I'm creating on accounting basics. If you missed the first, check out the link that I'm putting in the description below. This video is going to be all about the differences between debits and credits. Make sure you stick around to the end because I've got a tip that I think is going to help you loads. Oh, exciting stuff. Are you ready? Let's do this. To properly understand debits and credits, I think it's important to make a couple of points clear so we can remove any misconceptions. Debits and credits are neither good nor bad. Debits and credits are not the same as adding or subtracting. Debits and credits are words used to reflect the duality or double-sided nature of all financial transactions. If you need an analogy to help you visualize this, then you can think of debits and credits as heads and tails on a coin, since there are equal and opposite sides to every transaction. In the world of finance, money doesn't magically appear or disappear. For money to go to one account, it has to come out from another. Accountants consider every transaction to involve a flow of economic benefit from a source to a destination. What is economic benefit? Economic benefit is the potential for an asset to contribute either directly or indirectly to the flow of an entity's cash. I was saying that accountants consider every transaction to involve a flow of economic benefit from a source to a destination. Well, credits represent the source and debits represent the destination. Destinations that economic benefit can flow to include assets like cash, buildings, and amounts owed to you by others, but also expenses where a business pays a third party for a good or service they have provided, and dividends where a business distributes some of its cash to its owners. On the other hand, sources that economic benefit can flow from include owner's equity, where a business's owners give their cash to the business, liabilities such as amounts owed to a bank in exchange for a loan, or to suppliers for providing a good or service, and revenue. So let's bring back up that accounting equation that we discussed in the previous video, and I'll prove this to you. Assets equal liabilities plus equity. Now we know that assets are represented by debits and liabilities by credits. However, equity is a tricky one. To understand it properly, we have to expand it into the components that make it up. Now, full disclosure here, we're about to do some maths. Don't be afraid, we're just going to do some simple rearrangement here. If maths isn't your thing, maybe watch this next section through a couple of times so you can wrap your head around it. You'll be okay. Equity equals owner's equity paid in less dividends paid out plus retained earnings. I said in the previous video that we can think of retained earnings as profit held for future use. Well, profit is made up of revenue less expenses. So let's replace retained earnings in our accounting equation with revenue less expenses. We have equity equals owner's equity paid in less dividends plus revenue less expenses. And now let's take this definition of equity and break it out in our accounting equation. Assets equal liabilities plus owner's equity paid in less dividends plus revenue less expenses. And finally, let's do a little rearrangement. So we have dividends plus expenses plus assets equal liabilities plus owner's equity paid in plus revenue. The left-hand side represents debits. These increase when debited and decrease when credited. The right-hand side is the opposite. These are credits. These increase when credited and decrease when debited. Now, I mentioned at the start of the video that I have a tip for you to remember all this. This is going to help you out. Well, here it is. Dealer. D-E-A-L-E-R. Dealer. If you are ever in doubt which side of the accounting equation these terms sit on, then you only have to remember this one word. Dealer. Right, I think we covered a lot there, so let's recap some of those main points. Debits and credits are words used to reflect the duality or double-sided nature of all financial transactions. Debits represent the flow of economic benefit to the destination. Credits represent the flow of economic benefit from the source. Debits include dividends, expenses, and assets. Credits include liabilities, owner's equity paid in, and revenue. This is reflected through the accounting equation, which can be expanded and rearranged to show as dividends plus expenses plus assets are equal to liabilities plus owner's equity paid in plus revenue. An easy way to remember this is dealer. Thank you for watching today's video. If you found it useful, give it a like. If you're interested in watching more, don't forget to hit that subscribe button. That's all for today. See you next time.
This week, I sat down to look into every single financial model video on YouTube, and they all just focus on the spreadsheet part.
Hi all and welcome to this video.
So now what we can do is we can do exactly the same.
And yes, of course, a financial model is a spreadsheet, and we are going to get to spreadsheets today. But before we even touch spreadsheets, we need to get on the same page about what the financial model is, how it should work, and the most common mistakes that startup founders make while doing a financial model. Because it is a spreadsheet at which you throw data, you throw expenses, you throw assumptions about the business, you throw real benchmarks from other companies, and on the other side, this spreadsheet spits out some key company questions. But these are super key company questions. Some of them are really urgent, like almost like life and death questions for your business, like how much runway do you have? Which means how long do you have until you run out of money? Or can you afford that new hire that you're planning, or that new marketing campaign? Or if you're looking for investors, how much money exactly do you need to raise and by when? I've seen way too many founders just put in that we're raising $1 million with no backing of any numbers and not having run the math. And of course, what happens is that this falls apart the moment that investors start asking questions about what they plan to do. Now, other answers more midterm, like how big can the company get, or how much will it cost to get that big, or how effective will this marketing campaign be, or what the company valuation is today. Many companies, most companies I see, honestly, approach this by just putting out a few revenue assumptions or a few user acquisition assumptions. So this is how many users that we're going to get. We're going to get 10% more customers every month, and therefore this is how much revenue we're going to make every month. Or even worse, they'll just say revenue is going to grow 10% month over month for the first 3 years, period. And to do that, we're just going to put a number for what we plan to spend on marketing. And this is the team that we need to hire. And this, of course, makes no sense. The right way to do this is to understand the drivers of your revenue and to think of revenue as the effect, not as the cause. This approach is called driver-based financial modeling or driver-based planning. And in this video, I'm going to teach you everything that I know about it. We're going to draw some diagrams for a few common financial models together, and we'll get to turning that logic into an actual spreadsheet. So like I said, we're not getting into spreadsheets just yet. We work on dozens of these financial models for customers every year, and every single one of them starts with a canvas. Color coding here is green for revenue, red for costs, any expense that's directly proportional tied to revenue, like your servers or product manufacturing costs. And then blue is for SG&A, that's sales, general, and administrative expenses. Pretty much every other expense the business makes will fall into SG&A. And then yellow is for CAPEX, that's capital expenditures, which are expenses of cash that buy assets, like computers or stuff that you own that still has monetary value, even though you've spent dollars to buy it. Now, this color coding is used pretty much across every single spreadsheet that we do, so it's pretty easy to navigate and to tell what is what across the different pages. I've also placed links to all of these templates in the cards of the video, so you're going to keep an eye on those in that corner. Now, each of one of these categories is, of course, split into others, and most of them are pretty easy to grasp. For example, you can budget your rent or add your subscriptions to estimate how much the bill will be at the end of the month. Inside of SG&A, the easiest connection that you can make is connect your headcount to the cost of this tool. For example, your G Suite will be $6 a month per user. So you know that for every new team member that you add, you're going to pay Google an extra $6. If you work out of a co-working space, that's probably about $500 per seat. So again, you can tie those numbers together to always have an accurate estimate of what the expense is going to be. Now that is the easy part. I want to get to the good stuff. Now, if we were to draw out the model that I mentioned, the one that doesn't work, that's a model in which revenue is the input, so that's the driver. So you input revenue, and then that drives hires and marketing costs. But again, that's of course not how things work in real life. In real life, you spend money on a campaign, and then that campaign drives conversions. Or you spend money on a sales team, and then that sales team will drive new leads down your conversion funnel. Both that marketing campaign and that sales team are the drivers. They drive the revenue. But most importantly, they are blue boxes. You need to spend money so that if the campaign is effective, it'll drive revenue. So this is a blue SG&A expense box. When you look at this on a spreadsheet, it doesn't really make that much sense. And that's why I think people get very lost. But visually, I think it's a lot easier to grasp. And that's why we always start there. And it's these KPIs, the numbers in the arrows, that function as a reality check to see if your assumptions are real. For example, it's common knowledge that a cost per install for an app will range between $1 and $3 in the US, or that the cost of a click via Google Ads will rarely cost under $1. So this benchmark will help you keep your assumptions within reality. So let me show you a few common financial model examples. An app, for example, is driven by marketing costs, and those drive downloads. A percentage of those downloads become active users, and a percentage of those active users pay whatever subscription or in-app purchases you're selling. A B2B platform, on the other hand, will probably spend marketing dollars to drive new leads, to jump on a call with your team. Those leads will need to be processed by a human sales team. That's an expense. And maybe 100 leads per agent per month. And some of them will end up converting to revenue. So that driver marketing budget could be a lot of things, a combination of things. Could be sponsoring a booth at an event, or it could be Google Ads or influencer marketing. So your head of marketing will have to run performance numbers and understand the conversion rates and the cost per lead of each one of them separately. And that can easily be dozens of campaigns at the same time. But what the financial model really cares about is the macro trend, the general number. How much did we spend total, and how much did a lead cost? And of course, you can balance how simple and complex the model gets depending on how savvy you are and how well you understand these metrics. In its simplest form, you could go from the paid marketing budget to the cost of converting a new customer. In a more complex example, you can account for website traffic first, then signups, then monthly active users, and finally conversions. Okay, I want to pause for a second to clarify that the key here is not for the model to be perfect and to take every single thing, every single KPI into account. The key here is for the model to be useful for you. I'm on our company financial model maybe twice a week, always budgeting and estimating and finding new KPIs that we need to track. It needs to be easy to manage and respond to the needs of your business. It starts simple and it gets more complex as your business evolves, as you start to understand these spreadsheets a lot better. So what you can see here is that all of these revenue lines that we've talked about, they're all driven by an expense. When you're adding your own assumptions into the model, what you can't really control is how much you spend on a campaign or on a team, and how well it works by improving your product and bettering your conversion rates. That means that your assumptions are always grounded. There is no such thing as a 1 cent cost per click. There's also no such thing as a 100% conversion rate. It's also extremely unlikely that if you doubled your marketing from one month to the other, the same numbers will hold up, because aggressive spikes in spend usually lead to less efficiency. Now, there is one single exception to this, a driver that is not directly tied to an expense. There's only one, and it's organic traffic. Our business is built on organic traffic. We get about 1 million views a month on this YouTube channel, about 300,000 visits per month on our website. And that is not tied to an expense, at least not directly. If I go and double our media team next month, we won't get double the number of views on YouTube. It's not proportional. Same if we double our content, our SEO team, because it just doesn't work like that. But it does work. So to me, organic traffic is really the only exception of a driver that is not proportionally tied to an expense. And we will allow it in a model as long as it's taken into account as a reasonable expectation. So when using organic traffic as a driver, you have to keep 3 core rules in mind. 1, make sure that you're budgeting the team that will cause that to happen, even if it's not directly tied to that growth. 2, make it reasonable. Maybe look at your competitors' traffic. And 3, know that the more traffic you get to a website, the lower the conversion rate will be. This is because SEO depends on content, and a lot of your traffic, this extra traffic that you're getting, will be to blog posts or people reading, but not necessarily ready to convert. If your website is mainly landing pages, those of course will convert much, much better. Okay, so we've covered all these drivers. Now let's zoom into these revenue lines. We have modeled the cause for the growth, so we can look into the effect. So let's take the simplest case of an e-commerce platform. That's a combination of paid traffic and organic traffic that'll drive new orders into the platform. In the simplest approach possible, you could take that expected number of new orders per month converted from this traffic and then multiply it by an average order size in dollars or currency. You don't need to model and map every single SKU in your inventory. If you take the average order size and the average margin or the average markup that you're putting on products, that should give you a decent estimate of how much revenue and how much profit you're going to be getting. Now, that revenue must, of course, be tied to an expense, which is the products themselves and the shipping per order. And then SaaS is, of course, my favorite example. I see a lot of companies struggling to add plans to this, to break down how many people are going to convert to each one of these plans. But you don't really need that, at least at first. You can just use the ARPU. That's the average revenue per account or average revenue per user. So if you have a $50 and a $100 plan, chances are your ARPU will land somewhere in the middle. And you can use that estimate for your MRR. Multiply that by the number of new conversions. And then, of course, you have to account for churn. Customers don't stay forever, so you have to account for those monthly cancellations. Churn sucks. It's like startup cancer. We made a whole video about it. The point is that the numbers your model uses, these inputs that drive everything else, they're KPIs. And they're KPIs that you don't have to make up. You can ask other startups in your industry. And the very moment you have some real user data for your platform, you can plug those values and then create an estimate that's very realistic. In SaaS, for example, you can even tie in your MRR or your active customers to your server and infrastructure costs. Those might be close to zero today, but you need to know what those will look like when you have millions of customers. And when you're doing driver-based modeling, you can also create other connections to other expenses. For example, you can assume that for every 1,000 active customers on the platform, you're gonna need to hire a new customer support agent, which are themselves already tied to the Google Workspace cost and the Office cost that we talked about earlier. At the end of the day, you have a model that does the homework for you, but nothing works unless you understand this thing first, this that we've been going through. We've done hundreds of these models, enough to know that that part is so key. Okay, so I want to spend some time on the spreadsheet now, showing you how all these diagrams connect into numbers on a spreadsheet. But let me give you one real live example now. We have this new plan on Slidebean called the Financial Modeling Workshop, where we handhold you in building a financial model for your business. So for example, on day one, we give customers a blank model so they can start playing around with it. And then the plan includes 2 hours a month with a senior analyst that helps them build this diagram and helps them focus on what's more urgent for their businesses. And it includes 6 hours of our spreadsheet team to actually build the functionality on the spreadsheet, which is just spreadsheets, formulas, stuff. And since I'm training the new expanded team that's running this, I'm actually gonna be leading the next 10 projects that we book. So I'll play that senior analyst role and you would get a couple of hours of me every month. So the idea with this thing is very much a teach a founder to fish approach. So we want you to take what you need to learn and then to be on your way. It's not a plan that you stick around forever. So I'm dropping links below if you feel that this is something that might be useful to you or if you want to get on a call with our sales team to learn more. And then of course, this is how the model looks like in general. The spreadsheet, like I said, is this blank financial model that has been available as a free download for a while. Everything here is already connected. Revenue is connected to costs, to SG&A, to CAPEX, and they're all connected to the summary spreadsheets, to your financial statements, either monthly or annual. We also build a cap table, so if you intend to raise capital, you can also run assumptions on how much equity that is going to cost you and your co-founders. So on this spreadsheet, you can actually start bringing in your expenses. For the team and the salaries and the benefits, we actually built a separate sheet where you can manage all of that. But then the tough part here is that you have to bring this diagram into the model. My recommendation to keep things organized is to place all the inputs and the assumptions on the projections page. That way, everything that you have to input, everything that you have to change is controlled from a single page, so you don't have to be jumping across spreadsheets on the model. And keeping everything on the same page would eventually allow you to run scenarios. For example, to compare what would happen with one set of variables versus the other set of variables. But I don't want to get ahead of ourselves. The idea now is to list all these drivers because they're going to become inputs. They're going to become variables that will cause changes in the model, new calculations in the model. So a common practice that I use is to make variables blue and results black. That way you know which numbers you're supposed to be changing and which ones you're not supposed to touch. So here's how that e-commerce model ended up looking once we put it into the spreadsheet. We have the organic traffic, we have the paid traffic as drivers. We have an average order size, we have shipping costs, and then we have margin per order. Now in this case, we also added some functionality for reordering. So essentially, we're saying that a set of the customers that make a purchase become regulars, and they continue to make a set of orders per month, not from new customers, but from existing customers. So it's a bit of a loop in the model structure. On the mobile app financial model, for example, since there are so many possible ways in which an app can be monetized, the main driver here is monthly active users. That's a driver for the revenue lines, from ads to in-app purchases to subscriptions. But again, monthly active users is itself driven by real Blue Box's marketing efforts. Connecting these formulas in the background, that's the easy part. It's tedious, and that's the part where our team can help the most because they're super fast and they're super efficient at doing this. They do spreadsheets all day. But again, the key to all of this is you, founder, understanding what's happening behind it, understanding this logic behind the model. Okay, so time for all the resources. The Black model, that's available as a free download, link below. We've standardized templates for the most common scenarios, and they're all available for our Slidebean customers, so you can sign up for that with the link below. And then last but not least, if you need my team or myself to build a model more like this turnkey service, you should chat with our sales team. I'm linking that below as well. Hopefully this video allows you to zoom out from the numbers and the spreadsheet and just to understand the logic first before getting into building. For you to understand this logic, for you to get this is the absolute key takeaway that I want you to take from this video, because if you understand this, running your startup will be a lot easier from now on. Thanks a lot for watching.
how does the accounting equation work and what are some examples of using the accounting equation? The accounting equation states that assets always equal liabilities plus equity. Assets are what a company owns, and they are recorded on the left-hand side of the balance sheet. What a company owes is recorded on the right-hand side of the balance sheet and can be split between liabilities, what is owed to creditors, and equity, what is owed to shareholders. Assets equal liabilities plus equity. If assets go up, then liabilities and equity also must go up. If assets go down, then liabilities and equity also must go down. Let's illustrate the accounting equation with some examples. When the company is started, the entrepreneurs starting the company send cash from their personal bank account to the company's bank account. The company records $100,000 in assets. It is cash that the company owns. And $100,000 in equity. The money is owed to the shareholders. If we check the accounting equation, we find that assets of $100,000 equals liabilities, which are 0, plus equity of $100,000. What we own equals what we owe. The company then buys some inventory from a supplier on credit. Inventory is an asset the company owns. Accounts payable, an invoice received from a supplier but not paid yet, is a liability that the company owes. Let's check the accounting equation. Assets of $150,000 equal liabilities of $50,000 plus equity of $100,000. Next step is for the company to sell that inventory to a customer on credit. Accounts receivable are an asset the company owns. Invoices sent to a customer that have not been paid yet. To complete the sales transaction, the company not only sends an invoice but also ships the goods. Inventory therefore goes to 0. As the company sells the goods for $80,000 while it bought the goods for $50,000, the company makes a profit of $30,000. Assuming no corporate income taxes for startup companies, which is not the case in real life, the profit on that transaction will end up in retained earnings, which is part of equity. Let's once again check the accounting equation. Assets of $180,000 equal liabilities of $50,000 plus equity of $130,000. There can also be movement between accounts within one category. The company decides to buy a small delivery van to deliver the goods. Fixed assets, property, plant and equipment go up $25,000. Cash goes down $25,000. Assets of $180,000 equal liabilities of $50,000 plus equity of $130,000. The accounting equation is the foundation for double entry bookkeeping. You could even see the accounting equation as the most important concept in accounting, period. Assets equal liabilities plus equity. Want to learn more about business, finance and accounting? Then subscribe to the Finance Storyteller YouTube channel. Thank you. Prepaid expenses, an accounting term that deals with timing differences between paying for something and using it. This short video covers examples of prepaid expenses in your personal life, your small business, as well as large publicly listed corporations. We will also go through the prepaid expenses accounting entries. Let's make it personal first. One or more of the following examples of prepaid expenses probably applies to you. Have you ever put money on a travel card for use in future travel? Did you buy a prepaid phone card? Did you book an airline ticket for your summer holiday? If so, then you transferred cash prior to using the service you bought. That's a prepaid expense. If you check your balance on your London Oyster card or your New York MTA Metro card, then you are looking at the monetary value of the transportation services you have yet to use. Do you have any other examples of prepaid expenses in your personal life? Please post them in the comments below this video, as I would love to compile a list of as many good prepaid expense examples as possible. Prepaid expenses also apply in the business world. As a small business owner, I have a subscription to a financial newspaper. The current subscription period is running from June 1st, 2017 to May 31st, 2019. I prepaid €848.11, including discount and excluding VAT, at the start of the subscription period. Would it be appropriate to record that full amount as a cost in the income statement in the year in which I receive and pay the invoice? No, it would not, as the delivery of the newspapers will be spread over the next 24 months. A core accounting convention is the matching principle. Expenses should be recorded during the period in which they are incurred. This is where the balance sheet account of prepaid expenses comes in. In prepaid expenses, you record the right to receive future services that have already been paid for but not consumed. Here's how the journal entries for prepaid expenses work step by step. We first record the full invoice by crediting cash, money is leaving the company, and debiting prepaid expenses. Both cash and prepaid expenses are balance sheet accounts. Within the asset category, cash goes down and prepaid expenses goes up. We then have to figure out how to allocate the total amount to the years in which the service is delivered, when the newspapers are received. €848.11 for 2 years or 24 months equates to roughly €35.34 per month. In 2017, June 1st to December 31st is 7 months, so we transfer 7 times €35 from assets on the balance sheet to cost or expense in the income statement, by crediting prepaid expenses on the balance sheet and debiting subscription expenses in the income statement. At the end of 2017, the remaining balance in the prepaid expense account on the balance sheet represents 70 months worth of newspaper. Around €600, 848 minus the 247 we have now expensed. In 2018, a full 12 months worth of newspapers is delivered. Hence we transfer half of the total amount of the invoice by crediting prepaid expenses on the balance sheet and debiting subscription expenses in the income statement. At the end of 2018, the remaining balance in prepaid expenses is €177, 848 minus 247 minus 424. The remaining 5 months are booked in 2019, and I will then have to decide whether or not to renew my subscription. It is important to check at the end of the subscription period that the full amount of the original invoice has now been expensed. Is the sum of the debits and credits on the prepaid expenses asset account the same, and the balance therefore zero? It's not just small businesses that record prepaid expenses, large corporations do it as well, but with far bigger numbers. The Coca-Cola Company is one of the Dow Jones 30. When you look at the balance sheet and their annual report, you will find a line item called Prepaid Expenses and Other Assets. In the narrative that discusses the balance sheet accounts, the Coca-Cola Company states that prepaid asset expenses and other assets includes advance payments to certain customers for distribution rights, as well as to fund future marketing activities. The company expenses such payments over the periods benefited. Prepaid expenses, a useful accounting concept in your personal life, in small business, as well as for large publicly listed corporations. Remember to put your examples in the comments box below this video. Thank you for watching. If you enjoyed this
Let's take a look at variations in the level of free cash flow in an extreme use case, telecom giant Verizon. Verizon's free cash flow dropped very dramatically from a level of nearly $24 billion in 2020, on the left, to just over $14 billion in 2022, in the middle. a decrease of $9.5 billion in absolute terms and 40% in relative terms. Since then, free cash flow has partially recovered. From 2022 in the middle to 2024 on the right, it went up by $5.7 billion to nearly $20 billion. That's an increase of 40%. Be careful with the math here. A 40% drop followed by a 40% increase does not get you back to the original amount. $23.6 billion times 0.6 gets you to $14.1 billion. If you multiply this lower base number of 14.1 by 1.4, you only get to $19.8 billion. It's all about which number you apply the percentage change to. Why are variations in the level of free cash flow such a big deal? Let's zoom out to the big picture. Companies use free cash flow to pay dividends to shareholders, buy back shares, pay down debt, and to make acquisitions. In the case of Verizon, the main two in this list are dividends and debt repayment. At Verizon, dividends are a very constant and ever-increasing cash outflow and consume more than half of the free cash flow each year. Dividends went up from $10.2 billion in 2020 to $11.2 billion in 2024, an increase of about $200 million per year. These dividend commitments require some stability in free cash flow generation. For stock market analysts, free cash flow is a major input into their financial models, which in the end spit out a target share price and a buy or sell recommendation for the stock. In order to calculate the enterprise value of the company, which is the sum of the value of the borrowings and the market value of the equity, you could use a very simplistic approach to come up with a ballpark number. Take the free cash flow of the current year and divide it by a discount rate that is appropriate for the company. Based on 2020's free cash flow, that enterprise value calculation would have assigned a value of $340 billion to Verizon. Based on 2022, just $200 billion. Based on 2024, the consistency accounting principle. Achieving a high level of performance which does not vary greatly in quality over time. Transactions and valuation methods are treated the same way from year to year. You can't just jump back and forth between different methods of recording significant transactions. You need to apply consistency of method, so the financial statements are comparable year over year. That doesn't mean you can never change your approach, but only when you have a solid reason to do so. The horizontal analysis is used to evaluate a company's performance over time, spotting the direction of change in account balances and the magnitude in which that change has occurred. In this horizontal analysis of the income statement of Meta Platforms, we see a slight decline of 1% in revenue year over year, and a huge decrease in income from operations of 38%. It's very clear what the major cost category is that drove the cost increase: R&D, up 43% versus the prior year. In the vertical analysis, you express each line item as a percentage of a base figure within the financial statement. In the case of the income statement, that base figure in the vertical analysis is revenue. Revenue is 100%, and in this example, gross profit is 78% of revenue, and income from operations 25% of revenue. Objectivity. Verifiable facts versus subjective opinions or biases. According to this accounting principle, the accounting data should consistently stay accurate, be free of personal opinions, and be supported by independent and unbiased evidence. The main idea of materiality is that we are born to be awesome, not perfect. We try to avoid mistakes, yet they do occasionally happen, and some mistakes are more painful than others. Materiality is the threshold above which missing or incorrect information in financial statements is considered to impact the fair and accurate representation of the financial situation. The matching principle. What belongs where and when? Revenues and any related expenses, like cost of goods sold, are to be recognized together in the same reporting period, and/or expenses should be recorded during the period in which they are incurred. Full disclosure. The truth, nothing but the truth, and the whole truth. All financial information regarding business transactions must be given in full. It is important for users of the financial information to see the full picture, and for that we need full disclosure. In the annual reports of publicly listed companies, the section called Commitments and Contingencies in the notes to the financial statements is actually one of the most interesting ones to find out what kind of trouble the company might be in. The consistency accounting principle. Achieving a high level of performance. Conservatism or prudence. The main idea is that it's better to be safe than sorry. According to the conservatism principle, all anticipated or probable losses are recorded as and when they occur, while anticipated profits are not recorded, but only when the profits are earned. The going concern principle. The main idea, to be or not to be. Is this company alive and well? Is its heart beating at a steady pace? Or more formally, going concern means a business is financially stable and can operate with the expectation of indefinite existence, or at least for the foreseeable future. The opposite of going concern would be bankruptcy or foreclosure. The going concern principle. The main idea. Where is equity on the balance sheet? On Microsoft's balance sheet, equity is in two places. On the right-hand side of the balance sheet, but also on the left-hand side. On the right-hand side is the equity that belongs to shareholders of Microsoft. On the left-hand side, in non-current assets, is the equity that Microsoft holds as a parent in other companies. A preview to the case study on US GAAP versus IFRS financial reporting. For CNH Industrial, the most substantial difference is in the D of research and development expenses. This impacts all three financial statements: income statement, balance sheet, and cash flow statement. In my view, the second largest difference is in the way operating leases are presented in the cash flow statement. Several less substantial differences occur in the areas of goodwill, pension, restructuring, and income tax. Each of the financial statements also has some cosmetic differences between US GAAP and IFRS. CNH International is best known through its brand Case and New Holland. They are the number 2 in agricultural equipment, a top 5 player in the Americas in construction equipment, and a global financier supporting brands, customers, and dealers. In 2024, agriculture revenue was $14 billion, construction $3.1 billion, and financial services $2.8 billion. CNH is one of the very few companies that provide US GAAP and IFRS financial reports. This is a case study where N is 1. In other words, I am just reviewing US GAAP versus IFRS financial reporting for one single company. So it might be hard to generalize the findings. Let's start with putting the CNH income statements side by side. US GAAP on the left, IFRS on the right. Top line, net revenues side by side, and net income, bottom line, side by side. Revenue in 2024 was $19.8 billion in US GAAP and $19.7 billion in IFRS. Net sales, or revenues from sales of goods and services, is the same in both, $17.1 billion. The difference in revenue between US GAAP and IFRS is in the line finance, interest, and other income. And according to the notes to the financial statements provided by the company, this is primarily due to a different classification of interest income of industrial activities. What about the bottom line? Net income, or profit for the period. 2024 IFRS net income is 10% lower than US GAAP net income. That doesn't mean that the IFRS net income is always lower than US GAAP net income, as 2023 IFRS net income was 2% higher than US GAAP net income. Let's use the reconciliation of profit provided by CNH to understand the differences. IFRS profit at the top, US GAAP profit at the bottom, and the adjustments in the middle. First item on this list is development costs. It might not look very big, $15 million on total profit in excess of $1 billion, but on a cumulative history-to-date basis, it is huge, as we will see when we put the balance sheets side by side. What is different in the treatment of development costs? Narrative first, then a detailed look at the CNH R&D cost numbers. Under EU IFRS, costs relating to development projects are recognized as intangible assets when cost can be measured reliably and the technical feasibility of the product, volumes and pricing support the view that the development expenditure will generate future economic benefits. Under US GAAP, development costs are expensed as incurred. So what we see here is IFRS putting the matching principle first in this case, by capitalizing part of the development cost and then amortizing them once the product is selling. US GAAP puts the conservatism principle first in this case. Put all R&D costs straight into the profit and loss statement or P&L. As a result, costs incurred related to development projects that have been capitalized under EU IFRS are expensed as incurred under US GAAP. Amortization expenses of the capitalized amounts have been reversed under US GAAP. Having a look at the numbers by line item will clarify how this works. The R&D cost that both US GAAP and IFRS recognize as expense, which is the vast majority, are $727 million in 2024. Current year development costs that qualify for capitalization under IFRS are $197 million, an expense under US GAAP, not an expense under IFRS. The amortization of capitalized development costs from prior years is $0 under US GAAP and $171 million under IFRS. Impairment losses on previously capitalized development costs are $0 under US GAAP and $11 million under IFRS. In total, R&D costs are $924 million under US GAAP and $909 million under IFRS. Whether US GAAP or IFRS R&D costs are higher in a specific year really depends on the balance between the capitalization of development costs on one side and amortization plus impairment of development costs on the other side. In 2024, capitalization was slightly higher than the sum of amortization plus impairment, but only by $15 million, which is 1.6% of the total R&D costs for the year. But this development cost story gets a lot more exciting when we look at the cumulative effect on the balance sheet later on. Other adjustments is a line that mainly includes 3 items. 1. Goodwill and other intangible assets. Nowadays, pretty much since the start of the 21st century, goodwill is not amortized but tested for impairment under both IFRS and US GAAP. In the distant past, goodwill was recorded as an intangible asset and amortized to income under both IFRS and US GAAP, but with different amortization periods, maximum 20 versus maximum 40 years. The transition from the old treatment to the new treatment, also called the adoption of the new accounting standard, happened at different time points for CNH. And apparently this can still trigger a small P&L effect of $7 million between US GAAP and IFRS in 2024. 2. Defined benefit plans or pension accounting. Slightly different between US GAAP and IFRS, leading to a P&L effect of $19 million in 2024. 3. Restructuring provisions. IFRS places emphasis on the recognition of the costs of the exit plan as a whole, whereas US GAAP requires that each type of cost is examined individually to determine when it may be accrued. A $16 million P&L effect in 2024. The difference in treatment of development cost, as well as the other adjustments, lead to a tax impact. And on top of that, there are differences arising in the accounting for deferred tax assets and liabilities. That's the bulk of the substantive differences between US GAAP and IFRS in the income statement or P&L. In addition, there are some immaterial differences, items not big enough to get too excited about, as well as some cosmetic differences, which affect only the appearance rather than the substance. Here's an example of 2 cosmetic differences in the income statement that are very much related. Cost of goods sold under US GAAP is lower than cost of sales under IFRS, purely a matter of presentation. Interest expense under US GAAP is much higher than financial expenses under IFRS. These differences are related. In the IFRS income statement, interest and other financial expenses from financial service activities included within cost of sales amounted to nearly $2.2 billion in 2024. It's simply included in a different line item in the P&L. No need to panic about it. CNH balance sheets side by side in the form of the accounting equation. Assets equal liabilities plus equity. US GAAP, assets of $42.9 billion equal liabilities of $35.2 billion plus equity of $7.7 billion. IFRS, assets of $43.6 billion equal liabilities of $35.2 billion plus equity of $8.4 billion. 2024 year-end IFRS assets are 2% higher than US GAAP assets. 2024 year-end IFRS equity is 8% higher than US GAAP equity. How did that happen? Once again, we turn to the reconciliation provided by CNH. IFRS equity at the top, US GAAP equity at the bottom, and one item really sticking out in the adjustment section, the development costs that we previously encountered in the income statement comparison. For 2024, the difference was just $15 million, but on a cumulative history-to-date basis, it's more than $800 million. Assets equal liabilities plus equity. So we find the effect on both sides of the equal sign. Goodwill and intangible assets under US GAAP are $4.8 billion, and under IFRS, $5.6 billion. The difference between those two numbers is the carrying amount of the capitalized development cost. Carrying amount means the originally capitalized amounts minus the accumulated amortization and minus impairments. The difference in treatment of part of the development costs affect the income statement each year. And at the end of the year, this difference ends up in retained earnings in the equity section of the balance sheet. $800 million already taken as an expense under US GAAP, still to be taken to the P&L under IFRS. Just like the income statement, the balance sheet also has immaterial as well as cosmetic differences between US GAAP and IFRS. US GAAP overview of assets on the balance sheet on the left, IFRS overview on the right. On the US GAAP balance sheet, assets are listed from most liquid at the top, cash and cash equivalents, to least liquid at the bottom. On the IFRS balance sheet, it's the other way around. Least liquid assets at the top to most liquid at the bottom. CNH cash flow statements side by side on a very high level. Cash balance at the start of the year at the top, then inflows or outflows